They told you silver was capped. They told you the rally was over. They told you that Friday's sell-off was confirmation, that the move was exhausted, that the smart money had already left the room. Then Monday happened, not with an announcement, not with a headline, not with a press conference, but with price. Silver didn't hesitate. It didn't test support. It didn't ask permission. It surged. And by the time most Western traders even opened their screens, the damage was already done. Silver had already traded at $72 in Shanghai. Let that number sink in. Not on a futures chart in New York, not on a speculative options chain, but in the physical-driven, premium, heavy, delivery-sensitive Shanghai market. This was not a rumor. This was not a glitch. This was not a social media exaggeration. This was a price that cleared, and the banks were not ready. Because everything they had been relying on failed at the same time. The paper suppression failed. The liquidity backstop failed. The psychological ceiling failed. And what replaced it was panic. Real panic. The kind that doesn't show up in headlines, but shows up in order flow. To understand why Monday's move blindsided the banks, you have to understand what they were positioned for going into the weekend. They were positioned for calm. They were positioned for exhaustion. They were positioned for the usual Sunday night drift lower, followed by thin Monday trade that lets them reassert control. Instead, Asia opened with urgency. There was no dip. There was no pause. There was no attempt to fill gaps. Price jumped, and then it accelerated. This is what traders call a gap and go, and it only happens when the buyer is not optional. Retail waits. Funds negotiate. Banks scale. But forced buyers do not wait. Forced buyers hit the market, and that is exactly what happened. Someone had to buy regardless of price. And when that happens in a market already strained, already tight, already short physical availability, price stops behaving politely. The first shock was speed. Silver moved faster than models predicted, faster than risk systems expected, faster than desks were staffed for. The second shock was location. This move did not originate in New York or London. It originated in Shanghai. That matters, because Shanghai does not trade silver the same way the West does. Shanghai is closer to physical reality. It reflects fabrication demand. It reflects inventory stress. It reflects what metal is actually worth when it has to move. And at $72, the message was unmistakable. Silver is not being repriced slowly. It is being repriced abruptly. That is why the banks were unprepared. They were positioned for containment, not repricing. By the time Western markets opened, the pressure was already baked in. Every short position suddenly existed in a world where the reference price was no longer 60-something. Risk systems began flashing. Value at risk thresholds were breached. Correlation assumptions broke, and the first instinct was denial. This is temporary. This is regional. This will fade. But it didn't. Because the buying was not speculative. It was defensive. Banks were not buying because they wanted exposure. They were buying because they needed to reduce damage. Covering began quietly at first, then less quietly, then urgently, and with every contract bought back, price climbed higher, making the next buy even more expensive. This is the trap. Short covering is not linear. It is reflexive. Every buy creates more pressure to buy. And this is where psychology enters the equation. $70 is not just a number. It is a line in the collective mind of the market. Below it, silver feels manageable. Above it, silver feels unstable. When price approaches 70, behavior changes. Stops cluster. Options exposure explodes. Algorithms switch regimes. Banks know this, which is why they never expected to approach it from below with momentum already accelerating. That was the mistake. They assumed time. They assumed they could walk price lower, slowly, methodically, into year end. But time is exactly what they lost, because Monday did not give them time. It gave them velocity, and velocity breaks systems that were designed for stability. By mid-session, the realization had set in. This was not a trade, it was a transition. From suppression to discovery. From managed price to contested price. From confidence to fear. And the most dangerous thing for a bank is not volatility. It is losing narrative control. Because once the market stops believing the ceiling exists, it tests it relentlessly. And that is exactly what began. The panic did not announce itself with headlines. It revealed itself in behavior. Order books thinned. Spreads widened. Liquidity evaporated. And this happened at the worst possible moment for the banks. The calendar? Late December. The period everyone assumes will be quiet. Trading desks understaffed. Senior risk officers on leave. decision makers unreachable. Normally, this works in the bank's favor. Low volume usually means low volatility, but that rule only applies when supply exists. Right now, supply does not exist. Physical silver flows are constrained. Refineries are in maintenance mode. Mints are slowing output. New metal is not coming online, but demand is not taking a holiday. Industrial buyers do not pause their procurement because it is December. Online retail does not shut down because it is Christmas week. So you have demand without replenishment, which means inventory drains. And when inventory drains, price stops being theoretical. It becomes urgent. This is why premiums stayed elevated even as spot surged. Dealers were not lowering prices to attract buyers. They were raising prices to slow them down, and it still wasn't working. Now add thin liquidity to that environment. When desks are lightly staffed, nobody wants to be the hero. Junior traders do not defend aggressive short positions. They flatten risk. They buy. Not because they are bullish, but because they are afraid. Afraid of explaining losses. Afraid of breaching limits. Afraid of being the name attached to a blow-up. So when silver surged, the path of least resistance became higher prices. And that is exactly what the market took. There was another accelerant most people missed. Options. As price approached 70, call exposure exploded. Banks that had sold those calls were suddenly short gamma. That means as price rises, they are forced to buy more futures to hedge, which pushes price higher, which forces more buying. In a liquid market, this is manageable. In a thin market, it is explosive. The algorithm does not know it is Christmas. It does not know desks are empty. It only knows it must buy. And when it buys into a vacuum, price jumps. This is how you get sudden spikes that feel irrational. They are not irrational. They are mechanical. Structural fragility is being exposed. Now layer in Shanghai again. Because while Western traders were reacting, Asian markets were setting the tone. $72 in Shanghai did not collapse. It held. That alone invalidated the suppression narrative. Because if price was truly artificial, it would fail immediately where physical delivery matters. It didn't, which forced banks to confront a possibility they had not modeled. What if the real price is higher than the paper price? What if the arbitrage no longer closes? What if physical demand refuses to wait? That question is terrifying to a system built on paper promises, because once confidence cracks, paper contracts lose power, and silver is uniquely dangerous in that context. It is small, it is essential, and it is irreplaceable. Unlike gold, silver is consumed. Every panel, every circuit, every battery. Once it is used, it is gone, and industrial buyers know this, which is why they do not wait for pullbacks in environments like this. They front-run shortages. They buy now to avoid rationing later. That behavior pulls future demand into the present, which tightens the market further, which pushes price higher. This is the loop. And once it starts, it is difficult to stop without destroying confidence entirely. The banks attempted to slow the move. They leaned on futures. They increased margin requirements. They whispered calm. But none of that creates silver. It only creates hesitation. And hesitation disappears when inventory runs thin. By the time New York realized what Shanghai had already priced, the damage was done. The market had shifted regimes. From range to breakout. From expectation to surprise. From control to reaction. And now everything centers on one number. 70. Because 70 is not resistance anymore. It is a trigger. Above it, narratives change. Above it, media attention arrives. Above it, public psychology shifts. And that is the point of maximum danger for institutions that depend on stability. 70 is where suppression stops working. Below 70, silver can still be framed as volatile. Above 70, it becomes undeniable. That single-digit shift changes everything. It changes how traders talk. It changes how institutions model risk. It changes how the public perceives value. Below 70, silver is still treated like a commodity. Above 70, it starts behaving like a monetary signal. That is why the banks fear this level more than any other. Because 70 is not just resistance. It is exposure. Exposure of inflation, they said, was temporary. Exposure of shortages, they said, were manageable. Exposure of a system that relied on confidence more than reality. And once that exposure happens, it cannot be reversed with paper. There is another reason 70 matters, and it is technical, structural, and deeply uncomfortable for anyone short this market. There is no price memory above this zone. No trapped longs from the past. No legacy sellers waiting to get out. No historical ceiling for algorithms to lean against. This is what traders call blue sky. When price enters blue sky, behavior changes. People stop selling rallies and start buying pullbacks. Momentum funds activate. Trend-following systems flip from neutral to aggressive. And most importantly, doubt disappears from the long side and migrates entirely to the short side. That migration is lethal. Because a confident holder does not sell. They add. They hold through pullbacks. They ignore volatility. They stop checking the price every hour. And that is the worst possible outcome for a market dependent on weak hands. This is where psychology becomes destiny. When silver was trading in the 20s, people questioned whether it would ever move. In the 30s, they questioned whether it would hold. In the 40s and 50s, they questioned whether it was a bubble. Now, approaching 70, the question has changed. People are no longer asking if silver is too high. They are asking how much higher it has to go before it breaks something important. That shift is irreversible. And once it happens, price accelerates not because fundamentals change overnight, but because belief does. Belief that supply is tight. Belief that demand is inelastic. Belief that waiting is riskier than acting. Industrial buyers feel this before anyone else. They do not trade narratives. They trade necessity. A procurement manager does not care about technical resistance. They care about securing material at any price that preserves production schedules. At 60, they were annoyed. At 65, they were concerned. At 70, they are alarmed. Because 70 is where budgets break. It is where forecasts fail. It is where contracts must be renegotiated. It is where inventory strategy shifts from just-in-time to just-in-case. And just-in-case buying is explosive. It pulls future demand into the present. It drains remaining inventory. It removes optionality from the market. That is when price stops responding to selling pressure. Because selling pressure no longer exists. This is why 72 in Shanghai matters more than any chart pattern. It proves that somewhere in the world, silver is already trading in a different regime. A regime where physical reality overrides paper convenience. Once markets fragment like that, convergence happens violently. Either paper reprices upward, or physical becomes unavailable. There is no stable middle ground. The banks understand this, which is why their behavior changed on Monday. They did not fight the move aggressively. They retreated, they covered. They reduced exposure. That tells you everything. Institutions only retreat when the cost of control exceeds the cost of surrender, and that threshold appears to have been crossed. This does not mean the path forward is smooth. It will not be. There will be sharp pullbacks. There will be engineered volatility. There will be headlines designed to restore doubt, because doubt is the last tool available. But structurally, the market has shifted. The paper leverage has been exposed. The physical bottlenecks are tightening. The psychological anchors have moved. And once that combination is in place, price becomes unstable to the upside. This is why leverage is dangerous now. Not because the trend is wrong, but because volatility will be merciless. A $5 swing in silver is nothing in a repricing event. But to a leveraged trader, it is fatal. That is how people lose money even when they are right. The market will punish impatience. It will punish greed. It will reward only those who can remain unshakable. Because what comes next is not about guessing tops. It is about understanding structure. Silver is not rising because traders want it to. It is rising because the system needs it to be higher to balance reality. Higher prices ration demand. Higher prices signal scarcity. Higher prices attract supply that does not currently exist. The market is doing what markets do when pushed too far for too long. It is snapping back. Monday was not an anomaly. It was the first clean acknowledgement that the old range no longer applies. 70 is not the end. It is the beginning of the phase where silver stops being ignored. And once that happens, price discovery does not ask permission. It accelerates until equilibrium is restored. Where that equilibrium is, nobody knows yet. But one thing is already clear. The banks were not prepared for Monday, and the market does not wait for anyone to catch up.